JLL has done quite a bit in this country since they launched, and they're setting amazing standards by raising the bar year on year. They've clocked in some excellent business and high quality and high class business.
India is becoming increasingly attractive. There are a number of global private equity players who have had a first mover advantage of coming into India, setting shop early on. Some of those private equity players have then also teamed up with longer term sovereign wealth investors, sovereign wealth funds, who have a lower cost of capital and longer term hold aspirations.
So therefore seasonality has started creeping in, which was not the case, at least witnessed for the last 2 years, especially after COVID. People were just traveling despite of climate, but now that has started happening. Business travel also generally gets softened in summer, and this we saw it this summer as well. Plus, weddings do not happen in this season. So therefore, all these demand drivers were sort of muted, and that's where you see the flattening of the curve. Is this going to continue in the next 2 or 3 quarters? The answer is no.
Good afternoon, ladies and gentlemen. Welcome to this new episode of BWH Dialogues. On this show, we bring you leaders from across the world and across India, leaders who've set new benchmarks, who've scaled new heights, and as they look into the future. Today, I have the honor of bringing in Nihat Ercan. He is the CEO Asia Pacific for the Hotels and Hospitality Division at JLL. He's flown in from Singapore. Along with him, we have Jaideep Dang, who's the Managing Director of JLL's Hotel and Hospitality business in India. JLL has done quite a bit in this country since they launched, and they're setting amazing standards by raising the bar year on year. They've clocked in some excellent business and high quality and high class business. For all the ones who need any introduction, JLL is a global leader in the real estate services space with a strong focus on the hospitality sector. The firm is renowned for its expertise in investments, development, and advisory services across the globe. JLL's Hospitality Group is instrumental in driving major hotel transactions and provides strategic guidance to owners, operators, investors, and has made a significant impact all over the world. Let me now give you a very brief introduction on Nihat. He brings over 2 decades of experience in the real estate and hospitality space, leading JLL's strategic initiatives and transactions across the APAC region. Young that he is, his portfolio is pretty varied and rich. He's a man of various accomplishments, and he's known for his deep market knowledge and has played a pivotal role in shaping the investment landscape in one of the world's most dynamic region. Now a bit on you, Jaideep. I've known Jaideep for a while, so it's hard to speak on somebody who you've met so often and done a lot of work with. But he leads the Hospitality and Hotels Group in India, and of course the firm's business in the fastest growing market perhaps in this region or perhaps in the world. Young that he is, you've done 25 years, right? So, and he's driven significant growth and major transactions in the hospitality success, and he's also positioned JLL as the key player in the market. Enough said about you both. It's time to get on with the conversation that promises to illuminate the landscape of hospitality. Now, today, I shall straight away start rolling with Nihat with the first set of questions. Nihat, let's talk about, navigating shifts in the global APAC hotel investments. What are the key trends that you notice in the global and APAC investments in hotels, and how are the volumes in 2024 versus what they were in 2023?
Sure, thank you. First of all, thank you for having me over here today. It's really a pleasure to be in India. I love the energy of this country, and it's love to be able to return back again. So if we start at a high level across global transaction volumes, we've seen about $27.5 billion of transactional activity in the first half of this year. Overall, the trend is upwards. We're returning back towards the long-term average in transaction volumes. There are some marked differences though. Asia Pacific, and I'll talk about that a little bit later on. Asia Pacific and Europe are showing year-on-year increases in investment activity. But in the US, it's the opposite. We have seen a significant decline in transactional activity, really driven by the interest rate environment and the cyclical downturn that we're seeing in the market. That's resulted in a little bit of a stalemate in volumes. When you look at the peak of sales, 2015 is the watermark for the most activity that we've seen globally. There was $50 billion of transactions across the world. And in fact, in the Americas alone, there was nearly $30 billion of transactions in 2015. So when you compare against 2015, we're still a way off. However, the positive is that we're trending upwards. Now, if we distill it in the individual regions, within Europe, we're going to see about $11 billion. We've seen about $11 billion in the first half of the year. That's a fairly sizable increase. And a lot of that is being driven by portfolio activity. So single assets in Asia Pacific tend to dominate transactional volumes, whereas in Europe, it's roughly a balanced mix between single assets and portfolios. And most of that portfolio activity, I would say, is in the regional UK and the continental European market. And that's being driven by private equity that's invested in real estate, that's kind of acquired during COVID or in the immediate aftermath of COVID, is holding on to assets over a defined horizon and now looking to exit out of those investments. Whereas in the Asia Pacific region, we will have seen about $6 billion, 5.7 in fact to be exact, of sales in the first half of this year. That's about a 10-15% growth year on year. There are about 100 transactions across the region, and the average sale price per key was around $250,000. The value per key has gone down a little bit, so more smaller transactions are being done. But the second half of the year tends to be the more busier year for not just Asia Pacific, but globally. I guess a lot of fund managers and investors trying to get their last bit of acquisition before the end of the year. Personal incentives at play, perhaps. Capital allocations looking to be fulfilled. And certainly where I'm sitting right now, there are a number of big ticket sales, particularly in places like Japan and Korea and Thailand, and in fact India, that will trade in the second half of this year, and that's going to really boost transaction volume. So we're looking at about $11.6 billion of sales in 2024, which will be a marginal uptick on 2023 numbers.
That is very interesting. So tell me, you've spoken a bit about Asia and APAC, which is the most active investment market in APAC, one. And who are the prominent buyers? PE, pension funds, hotel companies, or family offices?
So the most active market in Asia Pacific is Japan. And Japan has historically been the most liquid and most active over the years. It's just that this year it has really driven upwards in volume.
What's the magic?
Well, the magic is interest rates. It's the one market where interest rates have remained significantly lower when you look at kind of the regional interest rate environment. There has been an upwards increase even in Japan, but we're talking from a negative territory to 0.25% only. And when you put that in the context of returns, cash and cash returns on real estate, there's basically a positive return, positive carry for investors. They're buying a Tokyo asset at, say, a 3% or a 4% return, but they're only borrowing really at 1%, maybe even less than 1%. So that delta is positive. But you take that delta to everywhere else in Asia Pacific right now, other than Japan, the majority of the markets are in the negative territory, which means in terms of the returns that you're making on your assets, your cash flow year in, year out is negative. So as a buyer, you're really banking on the reversionary value. So what is my pop on the sale? How much of a value add am I going to get? I'm going to invest in the asset. I'm going to turn the positioning of this asset around, rebrand, reposition, add value to the property, and I'm going to get my enhanced value on the exit. A lot of the investment in a negative leverage or negative equity environment is really being positioned in that way. Whereas Japan, you've got a positive carry in terms of your spread over your borrowing cost. But also the currency has devalued by nearly 40% against the US dollar. So that does make it a very attractive proposition for offshore buyers wanting to come into the market. They believe that the Japanese yen will eventually strengthen. And so from a cyclical entry perspective, it's a really good time to acquire real estate when the Japanese yen is weak, with a view to getting an uplift on the turn when Japanese yen strengthens.
As soon as it recovers.
Exactly. Beyond that, I think it's a very institutional market. So the profile of owners are mostly corporates who have non-strategic investments they're looking to divest out of, maybe railway companies as an example, but also a lot of private equity. And again, going back to typical investment aspirations of private equity, they tend to hold real estate for 5 to 7 years, add value and exit. So there's a lot of activity that's happening because of the institutionalized nature of the market. And then you talk about kind of growth prospects. There's the 2025 Expo happening in Osaka. At the same time, the integrated resorts, so casino, multi-purpose casino and integrated resort developments are on the cards in terms of new projects, and new infrastructure investment is coming. So all of that appeals to buyers who feel that there is more growth trajectory in the markets, and it's an opportunistic time to buy. Now, that's not to say Japan is the only market. Mm-hmm. It's the market where everyone is focused on at the moment. But then if I look at India, and we're going to talk a little bit more about India in a short while, there's a lot of growth and opportunity and energy in this market.
We have the people.
You've got the people, you've got the growth trajectory, you've got the world's attention. And I won't steal Jaideep's thunder, I'll let him talk about that in a while. If we move out of Japan, I'd say there are other markets of significance, but for very different reasons. So China still is a relatively active market. In fact, it's the second most active market this year. But the reasons why it's active is very different than the reasons why Japan is active. China is active because property developers have a lot of debt on their balance sheets. So they need to clean, they call it the 3 red lines policy in China. So they have to sell real estate in order to basically tidy up their balance sheet. And you know who's buying them? It's the state-owned enterprises. So cash is circulating within China. The domestic SOEs, who are effectively government-linked, are acquiring assets that are either underperforming or that need to be revitalized, or property developers need to sell. And that's driving a lot of that activity. Then kind of the third most active market, I'd say, is Korea. And Korea, again, has very similar sort of growth prospects and opportunity, such as similar to Japan. And then kind of we get into the several other markets like Thailand, the Maldives, and of course India, which features prominently.
Maldives and all a little later. I have a question parked for that. Let me bring you into India's role in the global hospitality investment landscape. You were just speaking about it. And explore our potential to attract international investments, especially from key markets like Japan, and the strategic moves of Indian investments abroad. The question out of that is, are these buyers looking at India yet? One. And do you think India is becoming an attractive market for inbound capital in the hospitality space?
So my short answer is yes, India is becoming increasingly attractive. There are a number of global private equity players who have had a first mover advantage of coming into India, setting shop early on. Some of those private equity players have then also teamed up with longer term sovereign wealth investors, sovereign wealth funds, who have a lower cost of capital and longer term hold aspirations. So we have seen global capital coming in. We've seen global capital flourish in this market and now even look at some exit opportunities as well. And I think, if you sort of go back in time a couple of years, China was a dominant growth story that a lot of the offshore players were looking at. For a variety of reasons, a lot of those funds are now skipping China and looking at that next growth market. And really, when you look at it in a regional as well as a global context, India, the most populous, burgeoning middle class, it's got all the right fundamentals in place, the right macro fundamentals to make this a very exciting and attractive investment destination.
And also talent. So
there's a huge amount of talent, really good quality talent. What is challenging is, of course, just that learning curve to get comfortable with the markets, to understand and get comfortable with transparency issues, a little bit of red tape that still needs time. So I think, these are not negatives. I think they're just growing pains that every developing economy goes through. And India is in that pace. And for an equivalent amount of risk that you take in that, there's an equivalent amount of return that you make as a result. So it really is balancing risk appetites with growth prospects and return opportunities.
Interesting, very interesting. You just spoke about the Maldives. So let's talk about Sri Lanka and Maldives, really. They are two prominent markets in the tourism space, right? And Sri Lanka has made a very good recovery after what they saw 2-3 years ago. And India's impact is increasing given the Indian traveler is topping the charts, especially in these island nations and all over the world. Indian travelers are now getting famous. Our numbers are huge. So tell me, are Indian hotel companies and capital sources shopping or exporting capital following the Indian travelers wherever they head?
They are, selectively, but they are. And I think we've seen this time and time again, with, back in the 2015s and prior to that with the outbound Chinese travelers, then Chinese investment kind of naturally followed into destinations where the Chinese were traveling to. And so I think we're sort of in a similar scenario here in India where, homegrown Indian owner-operators, but as well as Indian funds and investors and high net worth capital is looking at markets with kind of a strong outbound Indian demand base, and Maldives is one of them, and UK traditionally has been an equally strong market as well with the outbound Indian travelers. So there is money that is looking at strategically placing itself in these markets. The Maldives is an interesting one. It's a market that we've been doing a lot of work in over the last 2 decades. In fact, ever since I moved to Asia, it's been a market that's been close to my heart, and we've done close to $1.5 billion worth of sales in that relatively small Indian Ocean landscape. Now, what's attracting investors into the Maldives is that during COVID, Maldives demonstrated its resilience.
Only functional.
Completely functional, because it remained open. It was closed for maybe about a month and a half, 2 months, right at the very peak in the initial uncertain period. But, in the Maldives, it's one island, one resort. So naturally, social distancing works because all your staff stay in the island. They don't get out. And you can limit access to the island. So they were bubbles. These resorts were basically bubbles on their own. And so essentially by being able to promote that, and with every other resort destination around the world, unless you're going domestically to a domestic market, resort market, being closed, it was the most attractive. So what that meant was for a lot of owners that had assets in other markets that were bleeding, in urban destinations that were really struggling to make ends meet, that were relying on government handouts and support, Maldives remained open, and it delivered cash far in excess of what they would have delivered pre-COVID for a number of owners. And that cash actually helped sustain the trading and the overall profitability of the business in other sectors. So what that really means is, as an investor looking at putting money into the Maldives, it is a counter-cyclical diversification opportunity for a lot of investors. And you look at if you look at globally where money is going, roughly 53% of all investment is in urbanized centers, so urban assets. Historically, resorts used to attract about 10 to 15% of global volumes. That's now increased to about 20%. So
that's significant.
Buyers are looking at the importance of resort assets as a diversification tool within their overall portfolio to reduce that delta.
And Maldives fits into that story.
Global gateway resort destination in close proximity to major centers.
And the profitability has never really dropped. So
exactly. I mean, clearly, resort assets can be more volatile in their trading performance. So you have the benefit of kind of upswings, but then downturns can be just as rapid. We are seeing, not just in the Maldives, across the region from an operations.
But tell me, are Indian investors, Indian as in Indian investors, are they also making entries into these markets? Like I said, chasing the Indian traveler?
They are making acquisitions, or at least at this stage, they're reviewing opportunities. So we're having many more quality conversations with Indian capital than we were, I would say, 2-3 years ago. Now, it hasn't necessarily translated into actual deals that I can talk you through, but I can tell you that certainly based on the inquiries that we're getting, based on the conversations that we're having, I think we will actually start to see more specific examples of Indian corporates and high net worth investing. A number of Indian investors are also just indirectly sitting behind vehicles. So they may not necessarily be a direct investor, but they just like to kind of sit as an LP or a JV partner, as a silent partner, and let someone who's got the experience drive the asset, drive the performance of the asset, and then they just receive distribution.
So let me now walk across to you, Jaideep. We're talking about Indian investors, we're talking about India and the vicinity. So let's talk about investment volumes in India's hospitality sector. I have two questions there for you. Can you provide us some insights into the volume of investments in the Indian hospitality sector last year compared to this year? What are the main factors driving or hindering investment growth?
So, see, last year in 2023, we were about $400 million money invested in hotel assets, and I'm saying in the trade, meaning operating assets or specific hotel assets being sold, qualified hotel deals. And I'm not talking about the greenfield investment where people are building hotels. This is existing hotels trading, between a buyer and a seller, changing hands. So that was about 401 million last year. That's what we recorded. This year, we are expecting this number to be 437 million, So, which means that we're almost at 12-15% growth on a high number last year. Now, when was the last time such a number was traded? That was perhaps 2019, which was the pinnacle year because Brookfield bought Leela, and that was one single large trade happened in this country. If you see before that and after that, it was a bit of lull. But now you see, the investment volumes have increased to that level and becoming more stable year on year. So there's no blip as such. Secondly, we see that number of assets are also increasing. So this is not on back of one-off deal or one portfolio being sold. This is number of assets across cities, across markets, mixed-use developments which are being traded, So last year we saw about 22 hotel assets, and this includes the NCLT trade, A bit of stress.
All of it.
But largely decent value trades. And this year we envisage about 20 assets which will exchange hands. We've already seen in the first half of the year about $93 million.
You've done some big deals.
We've done some big. We've announced one. We will announce a couple more in the next couple weeks.
And a few in the pipeline?
And a few in the pipeline. And as Nihat mentioned, the same trend is witnessed in India as well. That second half of the year becomes a little bit more populous in terms of deal activity. But unlike the reasons there, which is fund managers driving, here, most of our auspicious time for real estate trade is around this time. So a lot of people, especially
Diwali
family
and-
offices and high net worth individuals who are major contributors to this investment activity, they look out for auspicious periods for deal closures and taking on new assignments. So that's why we also see a lot of action in the second half.
There is also the maturity factor. When does the deal, how much time does it take?
It takes time, yeah, absolutely, because these are all operating assets. In India, there are too many licenses, too many situations around an asset. So therefore, it
Tell
takes
me,
time.
JD, if I was to ask you, are there any particular segments, so to say, within the hospitality industry, such as luxury, mid-scale, or budget, that have seen more significant investment movements or activity?
Most active asset category would be upscale, call it entry level 4 stars, or maybe full service 4 stars. That's where most of the trade is happening. Luxury is less because it's tightly controlled by most of the Indian owner operating companies. So you don't have too much of stock available. And resort markets, we are still building. So there's not too much of stock. Let's say a Goa or a Jaipur or a Udaipur, they're all building. And people build hotel assets here to hold generally. So you don't have too many assets coming to the market in the luxury side. But I would say largely 8 on 10, it's upscale and upper upscale.
So which is pretty much up there. So you're just touching luxury.
You're touching luxury, as I call them for a layman's language, more sort of 4 stars.
Okay, great. So tell me, let's look at the profile of buyers in the Indian hotel market. Who are the predominant buyers in the Indian market currently, and how do real estate developers, HNIs, private equity firms and funds differ in their investment strategies and goals?
See, here in India, what we are seeing so far, it's largely driven by high net worth individuals, call them family offices or Indian business houses, which have generated wealth, especially coming out of COVID, either through stock markets, pharma companies, manufacturing, logistics. So people are from those sectors, people are putting money in hotels, buying these assets for asset and wealth generation, so to speak. A lot of this is also happening from the real estate developer community, because residential sold and how in the last 2 years. So real estate developers have better balance sheets than before to spend, and they're also diversifying their portfolios. So in our estimate, about 25% is real estate developer community. I would say more than 50% will be family offices, high net worth individuals, Indian corporates. I'm putting all of them in one bucket because they are the ones who have a longer runway and buy assets to own and to hold. Private equity in India is still less as a constituent on the investment side. The reason is that they look for scale, and India is still building scale. So you don't have things ready-made for them.
Do you see the scale coming?
We see the scale coming, but in India, development cycle is a bit longer as compared to other markets. Call it our various regulations, right from land to
Nihat
buying.
spoke about that.
Nihat spoke about that. I mean, right from buying land to buying cutlery, it's a long journey.
Yeah, the tape is more red than any other color.
Well, yes, it's getting better, but at least we see that it's still, the development cycle is still longer, and that's why I think the scale is coming up, but it'll take time.
So tell me, what are the emerging trends among these buyer groups? We just spoke about them, such as growing interest in specific type of assets and locations. I really want to ask you, because I see a lot of growth happening in tier 1, 2, 3, really, more 2, 3. What about metros like Delhi? Because I don't see much action here.
That's right. Again, Delhi, if you see, first in its history, the assets got built during the Asiad Games.
Delhi.
mid-80s, right? That was when the first critical mass of stock came
Till
in.
Aerocity happened.
Till Aerocity happened. So there was nothing between for the last those 25
And
years.
after that?
And after that, again, we see maybe Yashobhumi on the other edge of the airport will be the next parcel of growth, where you will have a few plots which will come in. But Delhi otherwise is very controlled. Delhi is well aided by its suburbs in Gurgaon and Noida, more towards south and east. And you saw some development activity in the last 10 years in both suburbs. But again, as I said, these are newer suburbs. A lot of real estate activity is happening and is followed by office stock and residential. So first, offices move in, residences move in, people start living in those suburbs, then they start spending on F&B and hotels, etc. So we are, that way is just following that trend. So I guess that stock is being built, trading will occur. But to your point, a lot of this trading is happening in, let's say, Bangalore, Chennai, Hyderabad, Goa.
Even Mumbai.
And I would say these new airports, newer infrastructure, that brings in Aerocity kind of models, where you will have qualified land parcels, you go to credible hoteliers or hotel developers to do that, and that's where you build the critical mass for the next trade or scale up to happen.
So good. Before I come to Nihat with one question on the side, I want to ask you about greenfield projects and new developments. What is the current state of greenfield projects in India's hospitality sector? Are we seeing any increase in new hotel constructions? I see one in the Aerocity. Or is there more focus on acquiring and refurbishing existing assets?
I think greenfield activity is at an all-time high. And it's happening, thankfully, across geographies. See, first, in our first wave of growth, we were all locked in to the top 7 cities, right? That's where the office stock was building up, that's where residences were coming, jobs were coming, and hotels were being built. Now you see a lot of this happening in tier 2 towns, tier 3 towns, and I give due credit to the airports, to government, how they are building infrastructure, how they are connecting cities, both by way of airlines moving in and also by way of fantastic highways, which are newer orientations and connecting cities. So therefore, people are moving faster. They are going to these destinations and going and staying for leisure, pilgrimage, business, of course.
Which is a big segment.
Which is a big segment, and that's why we see trade happening in those cities. The numbers that I told you about, 22 hotels sold last year, they were not all in Delhi, Bombay, Bangalore. They were spread across, which gives maturity to the market, right? Similarly, a lot of greenfield development is happening in such cities. We are busy, very busy doing feasibilities and work for banks and for real estate developers in getting these newer projects up, right? Not only from, let's say, valuations of feasibility perspective, but also JLL does a lot of work in project development. So we are building hotels for owners in such cities, which was never the case. So, for example, leisure for us was only Goa, right? Today it's much more beyond Goa, and even Goa is expanding, courtesy the new airport. Yes. So there is a lot of greenfield. In terms of numbers, I would say last year we were about 12,000 rooms signed, right, in various stages of development. This year we're already 16,000 rooms. By the end of the year, I think we'll touch about 20,000 rooms. And this is across segments, across cities.
So you're walking into one of my questions, but we'll come to that. I have this question for both of you. How do you anticipate this trend in the next few years, particularly in tier 2 and tier 3 markets, both of you? Because you're a frequent traveler to India, so you know this business better than most people do.
Sure. Well, I'll let you tackle it.
Shall I pick it up? Because
both of you,
yeah, sure. I think you were here in Goa last year, isn't it, for that wedding? So he definitely keeps coming back. The beauty is that most of these markets are also well connected with international markets. So earlier you only have to take a plane to Delhi or Bombay and then get into these markets.
Air
Today
connectivity is
absolutely brilliant, right from Calcutta to Chennai. or Delhi to Mumbai, you have everything
You go
covered
and tell
well.
the world that there are about 100 new airports coming in one country.
Right, right. And
Most
listen,
will be,
we were 771 planes flying, zipping through the country until last year. We have another 1,400 coming in through various orders that Air India is giving, and you keep reading about Indigo, right? And everyone's building capacity. So just imagine the amount of airlines that are, an airlift that's going to happen from these tier 1 towns to tier 2 towns. So therefore, that story is yet to unfold.
I'll tackle it from an investment perspective. I'd say that compared to the metros, the return opportunities in the second tier and third tier markets are higher, right? Just again by virtue of the risk rewards kind of relationship. So, what we've seen historically is that the regional UK market has attracted a lot of offshore investment because buyers are chasing higher yields and higher returns, whereas London as the capital has got a few opportunities. There's a lot of demand going into London, and so yields are compressed. Naturally, I think in kind of tier 1 cities here, yields are going to be more compressed relative to tier 2 and tier 3 cities, and we've seen that in Thailand, Bangkok against Phuket, Samui, and Chiang Mai. We've seen it in China with Shanghai, Beijing against Shenzhen or Guangzhou or Xi'an, and so I think it's kind of a similar story here, where as an investor, right, if I'm looking to allocate funds into the Indian market, okay, yes, I will definitely be looking for opportunities in gateway destinations. But if I'm really looking at returns, there's growth. And as Jaideep said, there is infrastructure investment, there is the direct connectivity. So the story is good, the overall story is good. And if I'm looking at a better pop on my exit, arguably cap rates will compress in those sort of markets. That gives me a better exit value. And that's going to drive investment.
so India has you all excited.
Absolutely, absolutely. I mean, when we're looking at transaction volumes this year, our anticipation of volumes, India is going to be relatively on par with Thailand. And Thailand has historically been a pretty liquid and active investment market.
Thailand has been huge for travel tourism, right? But yeah, I think India offers you more than anybody else. You've got the deserts, you've got the Himalayas, you've got all the beaches, and yeah.
See, I guess the offer was always there. I think the biggest story which is building is A, on back of infrastructure, B, as Nihat mentioned, see, we were never a liquid market. So people will buy land, build hotels, operate hotels. So it was a whole life cycle. Today, you have that option as an investor to come in at any point in that life cycle and trade, which was never the case. So that's why what he mentioned, we are almost to the heels of Thailand in terms of trading activity, which is never the case ever before.
Also the good thing about what's happening in India today is the younger generations become aggressive. All right, they're looking for a better bang for their buck, right? And they're ready to invest, and they're ready to prospect. Yes or no?
Yes, in India for sure. I see this trend emerging, and I've been working with real estate developers for the last 2 decades, and I've seen their older generations and new generations coming in. The newer generation of that investors,
capacity.
They're very prudent. They're not buying hotel for ego. They're not building a hotel for ego anymore. They're building it for an IRR, for a return on their capital. So they're more mindful as compared to, or as opposed to, what we would see in in early 2000 or mid 2000.
Correct, and more willing to explore different models of hotel operation.
Is this the case everywhere, or is it?
Yeah, look, I think we are seeing a new trend emerge, right? Lifestyle hotels across the region globally, in fact, are proving that they can operate at kind of at a smarter way of business, right? I think gone are the days of the traditional hotel lobby that was underutilized and it was just an empty space, right? As owners are looking
Dead
at
space.
How do you activate it? How do you create
How do you
a real buzz? How do you monetize it? And I think some of the new lifestyles, some new exciting lifestyle brands that are emerging across a multitude of big name, big household names, as well as the smaller players, is looking at real estate on a per square meter basis. How do I deliver value for my shareholders? And I do that by creating engaging concepts with my with the community, not just with the travelers, but everyone else around me. So I think, we're in for a really interesting road ahead in terms of how hospitality as a theme is evolving. There's offshoots, obviously, like co-living that are becoming major themes, adjacencies. Those adjacencies are attracting investment interest as well, as buyers are looking at diversifying. And with that comes, unique concepts that are driving the attention of the new millennial travelers.
Excellent. So let me come back to you. You just spoke about rooms. Let's talk about hotel signings and room growth. Can you provide some statistics on hotel signings and room growth in India for this year compared to last year? And are there any notable trends in terms of hotel categories or regions seeing the most development?
Sure. So I guess
let's talk some numbers.
So signings last year, as I mentioned earlier, was about 12,000 rooms. Right. This year we're already touching 16,000.
Are you talking JLL or are you talking the industry?
No, I'm saying industry at large. From the length and the breadth of the country, number of hotel rooms coming into the supply, or let's say what each brand is adding. So if I put that as a cumulative number, was about 12,000 rooms being added or signed last year. This year it's about 16,000 already. Our hunch is it'll go up to 20,000, which means all these international as well as Indian born international players, as I call them, because they're moving everywhere, they're all signing, right? And the good news is that they are signing big boxes, convention hotels. They are signing bespoke luxury assets in back and beyond. Could be smaller, number of keys could be lower, but could be very luxurious. So all of that is happening. Therefore, there is growth in that piece. As I said, from 12,000 to let's say about 16,000 already, may go up to 20. That's on the numbers. In terms of category, again, I would say mid-scale and upscale is the most active, because remember, a lot of these signings are happening in tier 2 towns. Real estate everywhere is very expensive, but let's say a 4-star hotel of a tier 1 city will be a 5-star hotel in a tier 2 or a tier 3 city. So that is the flexibility that these upscale hotels provide you as an investment to, let's say, a promoter, followed by mid-scale and budget because of mixed uses. A lot of our clients at JLL, and we have that advantage because we are servicing across asset classes. So a warehousing developer to a shopping mall developer to an office developer to a hospital developer would all approach us if they were to look at it in a complementary asset class.
GD, are these numbers good enough?
Well, okay, let me give you a comparison, give you a relativity. We will be about a little over 200,000 rooms in the city, structured, organized manner, right?
City or
country? Sorry, country. Yeah. And I'm not talking about the hotels outside the bus stand or Paharganj or other places.
No, we're talking about organized.
I'm talking about organized hotels. It's about 225,000 rooms. As compared to that, Bangkok alone is about 125,000 rooms.
Which is my next question. Yeah. How do you compare?
So look at the relativity.
Dubai, New York.
New York, they're all between 100,000 to 150,000 rooms per city. And we are talking of country. The good news is that India, as I said, now the growth is pretty now across. It's not consolidated in only 5 or 7 cities as it used to be. So it's growing everywhere, which is helping the cause, which means that we still have a lot of...
The good news is there is room to grow.
There is a lot of room to grow.
So there's a lot of, because we haven't seen the penetration and spread that we'd want. Nihat, what's your view?
There is certainly room to grow, and I think as every maturing market, there is going to be opportunity, right? I think we've seen that positive growth in the branded room inventory.
Yes.
And look, there's challenges out there as well, right? I mean, obviously finding the right land is difficult. Construction costs are on the rise. So I think there's going to be a lot of scrutiny around the feasibility of developments at the moment. But I'd say that at the moment, in an Indian context, there is a really good demand story, and as long as that demand story is there and the growth in demand is there, that's going to help the economics of what is planned to be built work.
And anybody who's sitting with land parcels which they bought a while ago, they have something going for them and for the industry.
That is right. So that is helping. Secondly, land prices across tier 2, tier 3 towns also is very expensive. So it's not only the tier 1 story. So there are entry barriers. So we definitely advise our clients to be prudent. We encourage mixed uses. If there are other better usage of land, we encourage that. And that's where their projects make more sense. So yes, there are entry barriers, there are challenges. And by the way, Nihat mentioned about Japan for its interest rates and other markets. Look at our interest rates. It's genuinely high and always been high. So therefore, our cost of debt is significantly higher than many other countries.
So your competition is not just the market, but our competition is also the banks, because people go into fixed deposits and a runaway market.
Yeah. So but I guess a lot of people are now moving beyond it. They understand that this is wealth generation and wealth creation
And asset owning.
and asset owning. So that is also on the rise, and that is encouraging investments.
The institutionalization of the market is also quite important for the activity to pick up. So, the emergence of hospitality-oriented REITs in markets like Japan, Thailand, Hong Kong, and Singapore have really helped drive up volume and liquidity in the market. And some of these REITs are, the sponsors behind these REITs are ultimately developers themselves. So they're basically developing, maturing the assets, and then injecting them into the REIT. It's an exit option for them. It also then creates opportunities for your average person in the street to be able to actually participate in the upside of the economy and and invest in these types of asset classes.
True. So Jaideep, tell me, I have this one last question for you. Let's talk about trends and future performance. After 2 to 3 years of strong performance in the Indian hospitality sector, after we opened up, do you anticipate a flattening of growth? Has it already begun? And how might this impact investor sentiment and future investments in the sector?
So last quarter,
I have another part to this question, that after you respond.
Sure. So last quarter, especially this summer, in India, we have seen glimpses of flattening. Now, blame that to multiple factors, right from we had a long national election season, followed by a very harsh summer. So therefore, seasonality has started creeping in, which was not the case, at least witnessed for the last 2 years, especially after COVID. People were just traveling despite of climate, but now that has started happening. Business travel also generally gets softened in summer, and this we saw it this summer as well. Plus, weddings do not happen in this season. So therefore, all these demand drivers were sort of muted, and that's where you see the flattening of the curve. Is this going to continue in the next 2 or 3 quarters? The answer is no, because we will get back into the festivities, the wedding season, the business travel, etc., and we back with a more stable government, for the next few years. So I guess that overall sentiment is positive. I guess it's not about flattening. We were anyways riding high with a very high base last couple of years, so we'll kind of get upwardly stable there. And that should not worry investors, because again, as Nihat mentioned, a lot of these investors in our asset class, they are here for a longer time, and they look at a longer gestation period, and they appreciate it's a cyclical business.
Investors and developers need to know the glass is not half full as yet.
Right.
So there's room to grow.
Right.
And they need to make an entry when the prices are still manageable.
Yes. And the good thing is that we are building capacity. Yeah. When you are building capacity, you're inviting maturity in that asset class, right? Which means then the private equity will have a bigger canvas to play on, and then it becomes more liquid. So I think from a short to a medium term perspective, Even this flattening of the curve, we're not too worried with that.
So tell me this one, you have to shuffle between both of you. Can you compare hotel stock and flow between segments like luxury, upscale, mid-scale, and budget across different international markets? What lessons can India draw from these comparisons? Just for both of you.
So in terms of, I mean, we've certainly seen a bifurcation in demand, both from a tourism demand and as well as an investment demand perspective, where, you know, in a post-COVID world, ultra luxury or upper upscale is performing extremely well, and so is kind of, I'd say, limited service or budget. The players in the middle are sort of feeling the squeeze a little bit, right? So we've definitely seen that bifurcation, and we've seen that sort of play out in places like Singapore and Maldives and even in Japan, where the ultra luxury segment has really catapulted in terms of rates. So I think that's sort of something in my mind to be wary of as sort of in this sort of new reality that we're under. I think, you know, we've got to also be mindful, as Jaideep mentioned, you know, we've seen that sort of flatlining of performance. That's not just India, that's across Asia Pacific. And so you've got kind of revenues that are sort of flatlining or rates that are flatlining. At the same time, we're still in a very inflationary environment. So labor costs are increasing, energy is still high, materials are high. At the same time, debt service costs are high because interest rates are high. So what's happening is net cash flow is being squeezed. And that is going to have an impact on valuations. And that is going to have an impact on how, kind of in the short term, how valuations are assessed. The issue is valuers need transactional evidence from the previous deal to be able to make a prediction of the next deal. What's traded are assets that are traded at a premium, because obviously there is a specific buyer pool for a specific asset. So we've not had necessarily a decline in values, but we're certainly feeling pressure. And again, that's where that bifurcation does become important, because you do want the rate growth to be able to exceed the cost pressures that you're under because of the rising wages and energy and so forth.
Interesting. Do you want to add to what he says before I go back to the closing question to Nihat?
So pretty much the same here as well. The factors are playing out in a very similar fashion. And that's where we see, especially in the last 6 months, the bid ask, again on a trade, has become a little bit more stretched, because sellers are now looking at, listen, the market's been behaving very well, so therefore this will continue forever, so hence I need that upside, which is actually not happening, right? Because the buyer also needs to have something for him to ride in the next 5 years, and therefore, you know, that bid ask is again kind of being stretched. So again, our job is to kind of get that reality check and get those yields back. As Nihat mentioned, there's those same pressure points we are seeing in India as well: rising labor cost, high energy costs, debt is always a situation. So therefore, you know, these GOP margins and the EBITDAs sort of just tapering down a little.
So tell me, Jaideep, typically a deal that's happening, there are a whole lot of influencers. There's a seller, there's a buyer. So who can help tip the decision?
JLL can help, certainly.
There you are.
Ultimately we create a marketplace.
Yeah.
There you are.
And as long as we can create that marketplace, we let owners see the true appetite
and
interest
check
for their asset. Now, whether that's higher than we think, or how higher or lower than they think, or otherwise, ultimately it's the market, and this is what the market is for your asset. And so, I think then you can make an informed decision as an owner as to what you want to do.
And you know, I think the beauty between what Nihat's been doing for 2 decades, and you know, a lot of people here in India, I think we've seen the cycles, and we've lived through them. So we definitely have history, a lot of data to tell the buyers and the sellers, listen, we've seen this before. So let's take those lessons, carry it with ourselves, and make informed decisions. And I think that's where we make a difference.
Excellent. That was a very smart answer, JLL. So let me come back for the closing question. Let's talk about future outlook. So if you were to analyze the current and future trends in hotel investments, what is the future outlook of hotel investments as you watch the trends?
It's a very nuanced question, and I can answer it in multiple ways. So,
Please do.
as a broker at heart, I have to be positive. So I am glass half full, and I am going to be positive about it. Look, I'd say I think we are positive about more liquidity as we look ahead over the next couple of years in the APAC hospitality space. A couple of reasons for that. So the interest rate environment, obviously, we've discussed it. It's really important and does come into play as we look at buyers' allocation of funds and investment in the region. We are, I think, almost certainly, fair to say, almost certainly going to see the US start to cut down on rates, and the Fed's going to start hopefully make some announcements in the course of this year with 50 or 100 basis point cut in interest rates. That's going to help drive rate cuts in other parts of the world. We've already seen some of that in the UK, for instance. That with the pressure on interest rates coming off, the financing environment is going to become a little bit more attractive vis-a-vis the spread that I talked about relative to where hotel yields are versus your cost of borrowing. So that should, in theory, catalyze more investment into the sector. So in markets where there's been a bit of a stalemate because you've got obviously a seller with a relatively high pricing expectation and the buyer's not necessarily being able to meet that expectation because of the nuances around cost of borrowing, I think we're going to see that gap bridge and gets smaller, and then that's going to catalyze sales. So that's one. We've spoken about the operating environment, and I think that's really important. So, as we sort of see this sort of flatlining of performance and then kind of more costs coming through, arguably your net operating income being squeezed, there is pressure on valuations. So then that does force sellers to come down to maybe a bit more reality or expectation of meeting the buyer universe. So again, I take that as a positive. The adjacencies that buyers are looking for are just as important. So we have REITs that are out of Singapore, for example, that are no longer just buying hotel assets, that are actually saying, I want to buy student accommodation, I want to invest in senior living, I want to invest in build to rent, I want to invest in co-living, and not just in Asia or in my home market, but also elsewhere. So we're going to see sort of that expansion of what it means for living. So anything really with a bed in it is, I think, going to start to become interesting, and we call that sort of operational real estate. I'd also say that I think as we look ahead, maybe on the headwind side, geopolitics, I think will play an important role, right? I think, this year more than half the world's gone to vote. And it is a huge factor because the rhetoric is really different. There are a lot of nuances all around the world. And depending on what the messaging is and how local governments, authorities are playing towards that messaging, it does influence how money flows. Case in point, mainland China is no longer investing in the US. Mainland China is investing in Singapore because of the close relationship between the two countries. Mainland China is investing in UAE because of the GTG relationships, right? Correct, as part of the Belt and Road Initiative. So we do see a lot of that, and I think we're in an ever more polarized world, unfortunately. And it's no longer about globalization, it's all about kind of protecting nationalism, regretfully. Whereas I just talked about cross-border investment representing nearly a quarter of volume. So buyers are going to be very nuanced to those, those macro issues playing out and how they then place funds. I think the final point I'd like to make is that when you look at closed-end funds that have raised capital for hotel investment, record amount of money has been raised in the lead up to where we are right now. At the same time, there is a record amount of investments that have been made that are sitting in funds that are now reaching the end of their maturity cycles. And some of those have already had extensions because of COVID. So those funds need to exit, or the LPs want their money back. So you've got this perfect storm. You've got a record amount of money on one side from the fund perspective, and at the same time, you've got these sellers or funds that need to exit. So ultimately, that should hopefully come together and should result in more transactional activity as we look into 2025 and beyond.
So you head Asia. So if I was to, Asia Pacific, right, the APAC, if I was to ask you, name me 5 countries in your territory that you manage in order, 1 to 5, which are the ones?
In terms of most exciting or where I see most important opportunity?
Business-wise, looking at the future, the most exciting.
Yeah, so top 5 picks that we've got at the moment when we look at volumes, and I'm not going to specifically touch on India because I'd like to let Jaideep answer that question. But if I taking
Just rate
ex
them,
ex
1,
India,
2, 3, 4, 5.
Tokyo,
Japan.
or Japan. Japan top the list, followed by I'd say Thailand, Korea, Australia because of the Olympics in Brisbane,
Oh yes,
and the Maldives.
and the Maldives.
Now, the kind of the positioning could move around,
What
but
follows?
this
What follows Maldives?
this would really be my
So
top 5.
5. So what would be 6? Let me extend that.
I'd like to maybe call it out for India. Yeah. Because when you look at volumes, I think India is now at number 6 or 7 in terms of total ranking in terms of transaction volumes within APAC. So I'd like to make a call out for India.
Right, and I think we must give you relativity. So Nihat's been coming back every year, and we see we were about number 10 or 11 3 years ago. So we've anyways moved a few notches above. So 6 is not bad.
So if I was to ask you the same question in 2030, right, or maybe 5 years from now, 2029, when our Prime Minister will go again to seek a vote, his 4th term, where do you think India would be?
I'd love to see it in the top 5 and ideally in the top 3.
There you are. So that's been an interesting session, right? So I've had a great time talking to Nihat and Jaideep. And thank you, Nihat and Jaideep, for sharing your valuable insights. It's been a most informative session, a very, very interesting session. And you've given us a good feel of the global and Indian hospitality market. Your perspectives on investment trends, market dynamics, and future opportunities have provided our audience a clear understanding of where the industry is headed. We've also done a ranking, and we'll come back in 2029. I'll be there, of where India is. Nihat says we'll be in the top 5 or top 3, hopefully top 3. If India is going to be amongst the top 3 economies of the world, it better be amongst the top 3 in the region. So as the hospitality landscape continues to evolve, the expertise of JLL will undoubtedly remain a guiding force for investors and operators alike. We look forward to seeing how these trends unfold and shape the future of hospitality in India, Asia, and Asia Pacific. Thank you, Nihat. Such a pleasure. Thank you for being on the show.
My pleasure.
Thank you, JD.
Thank you.
All right. So with this, we cap this episode of the BWH Dialogue. We'll come back again. Like I said, 2029, we'll get Nihat back here wherever he is in the world, wherever JD is. We'll look down here and see where we've gotten to. Thank you again. Thank you for watching the show.